I'd say we would edit this, but we're on Facebook Live, so welcome to the live broadcast of Integrity Squared's Halo Talks NYC. I have the pleasure of being here with my friend who I've only known for a short 19 years, Sal Venuto from Long Island and Macrolease, and Ashley Markowski, who we've become fast friends over some sushi a couple blocks away, and now is our go-to financing source.
Absolutely.
Nice to see you again.
Nice to be here.
Thank you.
Yeah, awesome. So we started back in the fitness industry, and it was 1999 when I got involved.
Right.
And things have grown and changed, and there's a lot more going on in the sector, and we're bringing in bright people like Ashley to help grow the business and the industry. So what I wanted to talk about today is one for you to both give us a little background on Macrolease and maybe have people understand that a leasing and equipment business and a finance company is not what it used to be.
Sure.
And you really a value-added partner. And your success is really based on the success of entrepreneurs and operators. So why don't you both give your backgrounds, and then I'll fire away questions, and I might throw some zingers in because I'm live on Facebook.
All right, absolutely.
Fired
Crushing it.
No pressure.
Fired up. Well, Macrolease has been around since 1969, believe it or not. I've been there since 1992. I financed a lot of other equipment other than fitness equipment until 2000, a lot of heavy industry equipment, things of that nature. In 2000, I started financing fitness equipment, and it's been a revelation. It's been a dynamite industry to be involved in. When I first got involved in it, was a lot of meatheads and, not too many high net worth individuals, people just lifting weights and running fitness clubs on a entrepreneurial basis, but not very sophisticated. As the years have progressed, that business has changed tremendously, and we see a lot of sharp numbers people, a lot of private equity in the market. The EFTs and the recurring income has really turned people on, and it's changed the industry tremendously. And so it's been a dynamite industry to be involved with. It continues to grow, continues to change. A lot of franchises have propagated and really taken over the industry in terms of on the commercial side. And but it's been great working with a lot of repeat customers over the years, and helping entrepreneurs. We work with mostly companies anywhere from a startup company to a company that's doing about $50 million in sales. That's really our bread and butter, and that's where we do the best job of consulting people and working closely with them, answering questions, and helping them open store number 2, 3, 5, 10 until they move on to the next stage in financing.
Gotcha. And Ashley, how'd you get involved in this industry? And as you know, which Sal might have told you or not, but once you get in, you never get out. So you will be a lifelong fitness industry Halo participant and executive. So
awesome.
Welcome to the industry, for better or worse. You're here, and you are here to stay.
Thank you.
So how'd you get here?
Kind of by chance. I graduated college with a marketing degree and a minor in finance. And I interviewed at, several companies, and, I started at Macrolease really straight out of college, and I've been there 5 years now.
Wow.
So, when I started at Macrolease, it was still predominantly in the industry, big box gyms. It was still, high volume, low price point, and boutique was really just starting to make a roar. And, there were some concepts that I found to be really, interesting. And I kind of, maybe it was my age, but I really saw, technology being a big part of, this industry. And, so over the last couple of years, it's been, amazing to see now the boutique concepts really, not just be a trend, but be here to stay, and technology be part of that. So I've been able to grow and watch the industry grow as well. It's been really amazing.
That's great. So just to start off, I would say that the equipment financing of a new club used to be one of the last things that you do as a club operator. When you're looking at a new location, I'm looking at my lease rate, I'm looking at my build out, I get my architect, I do the permitting, so on and so forth. And then at the end, I say, okay, I'm going to go and get my equipment financing package in place, and I've got my equity set up. Maybe you know that you can get it, but that's kind of usually the sequence.
Right.
And over the last several years, I think that's changed where, people probably call you first now and say, hey, I'm going to do this. And, what can you do for me? Not just on the equipment side and on the build out, but, also like, what do you think, Sal? What do you think, Ashley?
Absolutely.
So maybe talk about like the evolution of, like we're originally like you're doing a transaction back in 1992,
Yep.
and I'm just trying to get equipment out, and I'm trying to get a payment, and now you've got a relationship based business, and it's not transactional, but it's basically, if you're successful, you are going to build at least several more locations. So I need to make sure that you're successful, and I'm not going to look at what, whether you can make it or not. Like you're invested in this, not just, like it used to be, I guess. So talk about how that's evolved over time, how the industry has kind of changed their perception of like who you are and what you are, and you're not my lender anymore, but like you're my friend, you're my consultant, you're my advisor. So kind of fill in the blanks on that, because we're on Facebook Live.
We're on Facebook Live, and I think I'm the only one that you can see, but that's okay.
It's all right. It's all right.
They got a good shot there.
You do some lip sync for us.
I mean,
so talk about how that's changed to the better.
Sure. I mean, years ago, definitely people would come to us at the last minute to finance equipment just before it was being delivered, and so we could interact with the vendors. Now it's totally different. I mean, people call Ashley and I early on in the process, even before they signed a franchise agreement many times. And also in the past, people were interested in maybe opening up one facility and then see how it goes. Now people are buying area development agreements, and they're going to open up 5, 7 to hopefully sell those and move on. So they're consulting us early on. We're trying to understand what the full project is, because also we don't only finance equipment. We finance the full project, equipment, hard equipment, soft equipment, and tenant improvements. So they're coming to us early on. We want to understand who they are, what their background is, what kind of equity they have, what kind of liquidity they have, just to paint the picture in our mind on what we could do for them. And the more information that we have up front, the better we can consult them appropriately, because sometimes we may not be the answer for them, or we may be one of the answers for them, and we're going to tell them what we can do after we understand their full the full picture, their full scope, and then we'll tell them what we can do. We'll advise them and give them options. And so the more information we have, the more we can consult the client correctly. And also, we are totally into long-term relationships. We don't want to just do one deal. If someone's going to open up 5 or 7 facilities, we want to be there for all of them, and we want to help them and develop a long-term relationship. And, we've been successful in doing that, and that's probably one of the best things we love about our business is the relationships, is the people, because we're into lending money, but we want to help people grow and help people succeed.
Yeah. So, Ashley, what's been your experience over the last 5 years and coming into the industry with the level of excitement and actually being in a market where there's explosive growth, and you don't necessarily have to elbow people around to try and get business. I mean, it's there to get, and it's about saying, okay, look, it's not just the terms of this deal, but also here's what else Macrolease and you personally bring to the table, and Sal brings to the table. So talk about how that.
I would say, we've had most of our success in developing relationships with franchises, because, when there's a really well-established franchise, there's a lot of room for growth. And when you can have a really strong rapport with the franchisor and they trust you as a lender, they really open up the floodgates for you to develop relationships with, their franchise base and their network. And, I've had people at this point come to me who trust me, know that, we can deliver, and they'll ask me, they'll say, hey, what's out there in the market? Do you see anything that, another concept, or, what does it look like? And, and they respect my opinion. And, before they invest millions of dollars into an industry, they want to know the, the financial opinion on that. And, it's like Sal said, sometimes we get folks that are, it's before they've even signed their franchise agreements. And, that really speaks volume because our clients are putting their trust in us to a level to really hear, do we feel that this brand or this concept, is it going to be something that can really take off and sustain? And so, that's been a really, it's been a compliment kind of having that, trust.
That's great. So when you see, without naming names, but you see a franchisor that you've got a little respect for, maybe they've got either private equity capital, or they've got a really strong management team, and they've got a real infrastructure. Typically equipment finance businesses are saying, look, I'll cover the equipment, but you kind of cover everything else. So what kind of happened or transformed over the last several years where you've gotten to the point where you're comfortable, funding additional FF&E and build outs internally and the soft products? Is it because you've seen a validation of a business model? If you've seen a validation of the franchisee, talk about, because it's not typical what you're doing. So I think people need to understand that usually go and get, in other industries, get 80 cents on the dollar of like what that equipment costs, and you got to cover the rest. And I got to check your financial statement, and I got to look at your business. And maybe it's easier when you see the business models that are out there that are doing well. And if they get a good location and the franchisor approves it, that's kind of a stamp of approval to an extent, unless you go to one of these groups that stamps everything,
right.
Which is a problem.
Right, that is.
But talk about like how you got people internally to say, look, we should actually extend more credit. We can be more competitive. We can help more people, and we get more locations open. I'm not really taking equity risk because this model performs. So just to kind of talk about that.
No, it's a great question.
Thank you. I'm on Facebook Live.
I see that. Years ago, you're right. We used to lend, 70, 80 cents on the dollar on just equipment. And that was compounded after the financial crisis as well. Things really locked up after that point. Then we started lending to some groups, 80%, 100% on the equipment. And I guess two things really happened that forced us to now we lend 200% on the equipment, because we're not lending only on the equipment. We're doing project financing, hard, soft equipment, and tenant improvement financing. The first thing that happened, I would say, is competition. Competition forced us to do it. And it's not only equipment finance companies, because equipment finance companies traditionally would only lend on equipment. There was different types of lenders that came in, cash flow lenders, that looked at the cash flow of the entity. Regardless of the equipment, they would lend on cash flow. And so, therefore, we had to adjust a little bit because of the competition, no doubt about it. But the other point you hit upon was the validation of the enterprises and the type of companies we lend to. They were making money left and right, big time cash flow, and they produced, and they were able, we stretched a little bit and gave 100%, 125%, and before you know it, we gave 200% because the cash flow was there and the validation was there as the years progressed, and we feel real comfortable with the model. Also, the fact that a lot of our financing is franchise financing, and they have 2, 3, 8, 10 of these locations, and they're valued based on the EBITDA and on a multiple of EBITDA. So what we've convinced our credit people to a certain degree is you're not lending on the equipment. This facility is worth $5 million because of the EBITDA and the multiple of it. Right. And we've seen stores sell for this dollar amount. So therefore, your position, our position is stronger than just equipment. Sure. So I'd say those two things really, made that happen for us. Mm-hmm.
Well, he took all my answers, so thanks.
That's okay. You have a list of notes.
So, I think market value, enterprise value of a concept, exactly what Sal said. When you see these brands, selling at ridiculous multiples of EBITDA, I mean, it's from a credit perspective, you could say, okay, there's a market value on this concept. And, a concept really is only as strong as its market value, present day, right? Because there are concepts that, it can change at the blink of an eye, but we've, based on the growth and the success and the financial statements that we've seen, like Sal said, we were really forced by our competition to say, okay, we're gonna finance more than just equipment, and we're gonna lend against, your EBITDA, because tomorrow you could go out and you could sell your company and get 3 times the amount that,
Right.
we're lending on.
Yeah, so your coverage ratio went from 80 cents on the dollar of hard equipment to basically, if it was $2 million of equipment, just for the quick math for our people here, and this company had, let's say, $1 million of EBITDA, that's probably worth $5 million. So you're really loaning it like 40 cents on the dollar
Correct.
of loan to
value. Yes,
right?
yes.
And I think with some concepts, like, we stopped looking at it like we're going to go in and rip out this equipment and try to resell it. And we focused more on the brand recognition and the fact that it's an intangible asset. It's not something that you can touch. And although we are an asset-based lender for the most part, having that brand recognition is something that to us is more significant than taking a treadmill and trying to resell it for, a certain amount.
Sure. Well, one of the things that and maybe this isn't necessarily for the operators side of it, but if we flip over on our Facebook Live to investors or groups that are looking at the industry and saying, okay, how sustainable is the industry? Default rate on asset lending in this sector, except for like Bally Fitness as an example, everyone else, like, they find a way, even if they're in trouble or they're maybe, going through a shift in their EFT or new competitor comes, like, I haven't seen like an 18-wheeler back up and like pick up like 100 pieces of equipment
Right.
yet. So how good do you feel about, like, there's companies that come out and say, like, look, I'm going to finance the MRI at the hospital because they're definitely going to pay, because
Right.
no one's taking that MRI back, right?
Right,
It's
they need
mission critical. So, how have you been able to convince internally and also like showing the data of like, hey, the default rates on this are like, I don't know, 0.2%, right? Where it should really be like 4 or 5%, because it is like the MRI machine. 100 treadmills are equal to an MRI machine. Like,
Right.
they can't get them out and say like, hey, we're refurbing all of our equipment today.
No doubt.
Right.
Until we pay and they back the
And if they're
18-wheeler
branded,
back
forget
up
it.
there.
If they're branded, that goes down even more.
Right.
Well, I would say, first of all, the payment history has spoken for itself. Our payment history in the last 10, 15 years has been phenomenal, especially after the 2008 crisis, has been phenomenal. So that speaks volumes. And again, we're lending mostly to franchises, and these franchises continue to perform. And so those are the two main things. And also our underwriting. We do our due diligence. We underwrite and we do transactions that make sense. We'll take more of a risk than we did in the past because of the payment history of the franchisees and the franchise, and the fact that we've had, little to no losses, as much of the industry has done. So that's what's allowed us to spread our wings and really feel comfortable and continue lending. And in terms of the entrepreneurs coming into the business, they could see that fitness continues to grow. More and more people, people at Ashley's age, everyone Ashley's age is part of a gym. People my age, maybe 25, 30%. But I'd say Ashley's age, 40, 50, 80% of people are part of a gym. So it's not only people go and work out, but it's a
social thing.
It's a social thing.
Yeah.
It's a mental thing. People feel great when they work out. It's a social thing, like Ashley says, and it's really ingrained in our society, and it continues to change in the United States. A lot of boutique firms keep joining, and people are spending more and more of their disposable income on fitness.
Sure. So how do you, as you go through your, underwriting process, how do you look at a location where, there's already a lot of competition? Let's take like Paramus, New Jersey as an example. Within that corridor, you probably got 8 health clubs, from the Gold's Gym with Mike Epstein to, the Crunch and the I think it's a World Gym there. And so as you look at that, are you also taking a view of like how competitive is this area, or, is that how important is that? Because the market will continue to grow, but at some point, like maybe this little hub is a little too much for us to handle.
Yeah, we do. We look at, of course, demographics. We look at competition. We look at all of that. But, kind of like Sal said, there really is so much more growth in this industry that, what we do try to look at is if you, especially with like the boutique concepts, if there's a spinning boutique that's opening, they're not going to compete with like a yoga studio because they're offering a different product. And, I personally might want spinning, but my neighbor might want yoga. And so I do feel like we take that into consideration. So, we really are pretty flexible with that because we're knowledgeable in the industry and realize that, there's so much potential for the growth.
Yeah. Also, when you're dealing with the right operator does their homework. They're not investing $1 million, $2 million, or $3 million into a facility and signing a long-term lease and putting their name on the dotted line when they know that there's a risk that's too high. I mean, these guys and gals are smart out there. They're doing their homework. And that's the people we're aligned with because we do our homework as well. We want to work with the people who are going to succeed. And, we do our homework to make sure that they've done their homework. Right. And so, if something doesn't make sense, we ask a lot of questions. And we want some good answers. And if we're not going to get the right answers and we're not going to get a comfortable feeling, we're not going to do that deal. But 9 out of 10 times we get the right answers and we do the transactions because the people we're aligned with are sharp folks.
And they're capitalized, So if there is a hiccup or something where another concept maybe, opens up down the block, they'll have enough capital to sustain, maybe a bumpy,
It's a great point. Yeah.
Time in the
Absolutely.
road. So.
And then, as you look at the equipment manufacturers and you see, the warranties that they're giving on the equipment so that maybe the resale value is higher in a worst case scenario. But also when you look at Planet Fitness as an example, they've got a replenishment, every 5 years they want you to replenish the equipment. I feel like the market for used equipment, if it gets cleaned up over time, like there should be a much higher resale value. I feel like a lot of guys and gals, when they get new equipment into a location and refurb the place that they just get like 10 cents on the dollar. They've already paid off your lease.
Right.
But, they get 10 cents on a dollar and then basically someone comes and picks it up and then they put it on a shipping container and it goes who knows where, either south or east. Right. So, as you look at the market and you say, okay, there's all this fitness equipment out there, do you see more equipment going into hotels? Do you see what other areas are you seeing people come to you and say, I want a health club in my residential building. I want to basically take an office building. I want to turn this into, a mini club. And is there a way for you to help connect some of the dots to say, look, maybe you don't want to buy this new equipment from Precor, but I'll hook you up with this really good, like
a secondary vendor?
Yeah, like a Mercedes, pre-owned type of thing.
Right.
Like, I feel like that hasn't really evolved yet, but I wonder if that's like another adjunct to your business that you get comfortable with.
I mean, it's not something that we really manage too frequently, but it is definitely, I don't want to say a problem, but it's something that, when it comes time to refresh this equipment, it's kind of like that question mark of like, who are we going to sell this? Are we going to donate this to charity? Are we going to, and, we were just talking about this the other day, Sal and I, and this could be a billion dollar idea, but we wish it was like maybe a product would be out there, like a treadmill or a rower that would be, or elliptical that would be like something like biodegradable, almost like you can just put it in like a machine and it could be recycled. Because I feel like there really is a problem. I feel like there are these warehouses out there with all of this equipment, and there's not enough places to put them. And if they're branded, by the time you strip down this equipment, and so we would love to come up with a product that is biodegradable.
Well, before you come up with the product, we did a deal with the FDNY. We did we call it the Halo Fitness Equipment Halo FDNY Fitness Equipment Fund. So we've gotten about $300,000 of equipment donated to the fire stations.
That's awesome.
Okay,
and they'll take it.
That's great.
That's wonderful.
I think
so
more.
We should try and do that across the country.
Clients ask me, especially when they're refreshing, they're like, Ashley, what do I do with this? And I'll make a couple of phone calls to secondary vendors, but that's really helpful.
If we could hook up with that afterwards.
That's great.
So a quick story, and just for the people on the call here, like on the line here, you can get me on.
I'm going to try to do this without causing a collision.
There you go.
Oh, there you go.
Hey, all right.
There you go. That's right.
Wasn't a call-in live.
Yes.
There you go. So the what happened was we did this event at you could train like a firefighter for a day, which was the most unbelievable experience.
Could imagine some
and
workout.
humbling
Gosh.
experience.
Yeah.
And I have a whole new respect when I see a fire truck coming down. These guys coming out with like their pitchforks and their
80 pounds of gear.
Yeah,
and we went through the whole thing, and then and we did it with some people in the Halo sector and some Crunch executives, and at the end, the battalion chief said, "Hey, I know you guys work in the health club industry. Can you get me some equipment for our stations because we don't? It's not funded by the city."
Wow.
I'm like, oh, these guys, like, all they do
That's crazy.
is like climb stairs every day. So I'm like, yeah, send me a list. So I'm thinking he's going to send me a list of like, I don't know, like 8, 10 stairmasts. He sends us a list of 373 pieces of equipment.
You asked for it.
Yeah, I'm like, okay.
Nice.
So we did a drive where we had a number of health clubs and a number of studios raise money for a day. And then we used that money to buy equipment, and then all these clubs donated a lot of their equipment.
Nice.
So that would be definitely a great venue if we could do that. And then it should
Would
really
love
be
to do
proliferate,
that.
like to fire departments, police stations,
Yes.
so they can work out there.
I think there could be a big
Let's
venue
do that.
there.
Our dad's
I think-
actually a volunteer firefighter,
Oh,
so
really?
we have a little,
Whereabouts?
connection. Freeport, New York.
Oh, nice. Okay.
Hose 1, baby. Woo!
Hose one.
I
I
think
like it.
there's tons of equipment out there, and there's no reason why something like that can't be put
Yeah, and
together.
they could take a write off, and also
Exactly.
use it for on the marketing side. So we'll
to
sync
know.
up with you on that
For sure.
So just in closing here, what advice would you give to someone who is coming into the industry? Maybe they're coming from banking background, consulting background. They woke up yesterday and they said, "Oh my God, like I hate my job, but I love going to the gym, and I love going to the studio, and I need to turn my passion into a profession." So how would you say, if I said, "Hey, call Sal and Ashley before you do anything," what would that conversation be that I can like listen in on and like wiretap right now?
Sure. I mean, first thing is do your homework in terms of what type of studio or fitness center you'd like to invest in. Make sure you're well capitalized. Ask a lot of questions and figure out where you want to put it geographically. See what kind of competition is there and what type of growth potential is there. And also align yourself with the right partners. It's most important to align yourself with the right franchise and the right partners that are growing and moving in the right direction. That's what I would say.
Yeah, exactly. And I would just say, look at the industry and make sure that you're investing in a concept that has learned from the mistakes that have been made prior. Because I really think that if you look, and you take the time, I would say take time. Don't rush don't feel, bullied into signing franchise agreements or term sheets with lenders or, really like this is something that you're putting your hard-earned money in, right? I mean, people are liquidating their 401ks.
Yeah.
They're, taking home equity lines on their real estate. So, make sure that the entity that you're investing in, whether it's a franchise or a mom and pop or whatever it is, make sure that you're looking at a concept and knowing that they are not making the same mistakes that have been made before, whether it's from a technology standpoint, a marketing standpoint, and that's pretty much it.
That's great.
Agreed.
So what's the best way to contact you for go to macrolease.com?
Facebook Live. That's the only way we...
You guys got the .com address?
Absolutely.
Awesome.
Macrolease.com.
We're
Absolutely.
legit.
So we'll see you guys at URSA. We will send people your way and vice versa. And let's get the used equipment to the FDNY.
Yes, that's wonderful.
And let's get the new equipment to people and get some more health clubs. And hopefully we get 50 million people working out instead
I
of...
hope so. You hear that,
Absolutely.
Facebook? We need everybody on some
instead of 30,
equipment.
Or 50 to 60
Yes.
to 70.
Yeah, baby.
And
We thank Integrity Square and Pete very much.
You got it.
And Dave
you so
for
much.
hooking us up here.
thanks for coming on.
Bye-bye.
It's exciting. Thank
All right,
you.
guys.